Good day, fellow value investors. There was this great comment whether value investing ETFs fit my investing framework for going forward, which has to be based on value investment if you want to do good in the future. And in this video, we're going to go through some value investing ETFs so you can see the risk and reward, whether it is real value and not, and then you can see how that fits your portfolio. We'll do VTV, we'll do IWD, we'll do Schwab value investing, and let's immediately start with Vanguard Value ETF. So the positive with such an ETF is that the expense ratio is ridiculously low, and that is thanks to Vanguard that changed the industry and gave something for what we can call for free. So nothing wrong there. The yield is 2%, okay, better than the market, and they try to track the US large cap value index. They have a style, value, large in the Vanguard metrics, and then I went to look, okay, what is their definition of value, went to the prospectus to check it out, and they follow the CRSP US Large Cap Value Index, so I had to go there to check what is value, and then they represent the value style for companies covering 85% of cumulative capitalization of the CRSP US total market. I had to dig even deeper there to try to find what is the explanation of value. They just use book to price, forward earnings to price, forward, so nothing to do with value investing, historical earnings, okay, dividend to price ratio, and sales to price ratios. Okay, so a lot of work to find what they define as value, and yes, compared to the S&P 500, it is more valuable because you have a basket here, a basket there. The dividend yield is 1.2 for the S&P 500 and 2% for Vanguard's value fund. However, when it comes to value investing, the first rule of value investing is that value investing is not relative investment. Value investing is absolute investment. So 1.2% or 2%, it is a huge difference when compared one to another. But in reality, it doesn't make much difference in your long-term wealth accumulation. Comparing to one stock that we recently analyzed on our quadrant and discussed here, so dividend yield 9% here, 2% and 1%, we can debate forever what is value and what will most likely increase your wealth over time. But value investors, let's say, seek more than this. You cannot call 2%, one of the lowest yields in history, value. But that is how they calculate it. They likely get paid, affiliate of the university in Chicago, and what they say is adopted blindly. Let's look into the holdings. And just quickly, okay, diversified, most is in financials now because you have Berkshire, head of the pack, JP Morgan, and then you have many other companies there. Now, when it comes to Berkshire, I already discussed that at 1 trillion in market capitalization, don't look at the P ratio of Berkshire, that's just accounting, and let's say 40 billion of value creation per year, the P ratio is 25, and Warren Buffett went all into cash. So yes, Berkshire from current perspective is a value investment from that hedge perspective, but on the other hand, it is on the historically most expensive price to earnings ratio for Berkshire, which has usually been between 10 and 20, and we are now at 25. Nothing wrong with Berkshire. Again, cheaper than the S&P 500, it is a hedge, it is everything, so much better than the S&P 500 for sure. When Berkshire is cheap, value investing rule 2, Warren does buybacks, and if we look at the last buybacks, he did them in 2020 and 2021, and he has minimized those over the last 12 months. If we look at other details, we have JPM, it is a big bank, so now it is doing great. Again, value investing should be the inverse of this. You buy value when they are doing bad and not at the top. So if you buy an ETF now, you're paying top money for such businesses. And if we look at earnings, JPM has enjoyed the last few years a little bit of rising rates, and they have almost doubled their earnings, which for a bank is a lot. And now this is priced in and the stock is already going higher. But just look at normality for JPM, it's much more stable. And consequently, net income is there, stable and not exuberant now. So the key is to look for value across the cycle and not buying at the top of the cycle, which is what normal ETFs do. And if we look at net income, we have seen these ups and downs, and then up. And now we are at the exuberant part, and if you buy an ETF, you buy the most of them. Okay, still better than the S&P 500, but it is still a bank, don't forget that. Then there are other holdings. I prepared this before the unfortunate situation with United Health's CEO, but despite that, the P ratio is 40, the dividend yield is ridiculously low, and I don't know how that can be considered a value investing. Yes, their projection was for earnings per share growth of 13 to 16%. They are delivering that, but they are still an insurance company, and even with the charge that they had here, the real P ratio is 25, a little bit less than the S&P 500, but still expensive. And they are paying some dividends, doing repurchases with their money to grow earnings. But always keep in mind with these insurance companies, the Thanksgiving turkey. And the Thanksgiving turkey story is they analyze the market and the risks, and everything looks great. Historically, there are no risks, nothing can happen, and then the model crashes. And these kind of companies, some of them every 30-40 years, as would Charlie Munger say, these insurance companies all go bankrupt every 30-40 years. The bank average is 50 years. So yes, everything looks good, looks great, but again, Warren Buffett is the insurance that will not go bankrupt. All these others, I wouldn't bet on it. So again, risk, when it comes to value investing, you can't just model it. You have to also use common sense to check it out. If the insurance companies are having all those profits piling up, you know something in the system is working differently than it could work, and that is again a risk. And value investing is about risk. Not great price to earnings, not great earnings. It's about managing the risks behind the scenes, and that is something that an ETF can never represent. As Nassim Taleb discussed in his book The Black Swan, discussing Fannie Mae, when I look at the risk, seems to be sitting on a barrel of dynamite, vulnerable to the slightest hiccup. I don't know whether the slightest hiccup can change some companies here, but we'll see in the future. However, something that has nothing to do with value investing, 148 P ratio. If you look at historical net income was even lower, price to book value is 12, and that is at the top of the ETF. Another one, Walmart, retailer, P ratio 48, dividend yield 0.88. This has nothing to do with value investing. And you see this stock price and you think the stock is booming, and then you see revenues slow and steady up, net income flat, nothing ridiculous. And then you see this. This is a bubble. We'll see how it ends. And yes, the projections are a little bit improved from earlier, but this is again retail, and the market is just seeing 1 year of good, and look at this. This is insane. Again, nothing to do with value investing. They are returning to shareholders, of course, doing their buybacks, etc., but this is getting crazy. And the value investing rule, P of 40 for retail, can't be value. Let's discuss other value ETFs. So we have iShares Russell 1000 Value ETF, and same story there, same companies practically, one here, one there, extremely expensive. Schwab, again, same companies there, and here they have Exxon, Home Depot, but again, extremely expensive. And if we look at the numbers, again, the good thing is the expense ratio, but it is better than the S&P 500. Keep in mind with these P ratios, if you just click here, you see that it doesn't include the companies that are losing money, so therefore the P ratio is skewed to the, let's say, better side of the P ratio. But then again, dividend yield 2%, okay, better than the 1.2%, but still extremely expensive. And then when you look at the Morningstar small cap ETF, if you look at the components there, okay, they luckily had this in the ETF and then now it's the top position as it went up crazily. But if I look at price to book value, 53 times price to book value is crazy. This is what happens with these bets. It either goes bust or it resurges, and this was a great resurgence there. But when I look at this, they have 1 year of profit and now it looks like something miraculously. But look at the high debt levels, and if they can get out, yes, maybe. But then you have others like Tapestry or former Coach, P ratio of 20, nothing spectacular there. So my conclusion is that you cannot model value, and that's one of the problems with these ETFs. They just select what looks a little bit more value compared to the market average. But if the market is in a super bubble and you buy a bubble, you can be more value, but when things crash, you will crash equally to the others, if not more. So that's not value investing. There is no focus on risk. So first comes risk, and then you look at the good reward. This would be value investing. If I invest 1, so maybe I get 3 in 5 to 10 years, maybe I get 1.5. This is the uncertainty value investors are looking for. This is value. And if I look at ETFs at the risk, I can have 0.5 easily in the next 5 years, and then the dividend would be not 2 but 4%, but it would take me 15 years to cover for the losses. That's not value investing. So first you look at no risk, good reward, and you think the market is irrational, therefore you don't buy the most expensive stocks. It's very hard to model, and everyone is chasing the US, and you cannot have a value investment in the US when the US is 64% of the global market capitalization. You will never hear iShares, sorry, there is no more value according to our models in the US, we are going to shut down the ETF and not take your fees. They're not going to say that. They are just going to continue like that, delivering a service to whomever buys that. So nothing wrong with value ETFs, but from an absolute investing perspective, there's no value there. Especially with Warren Buffett having 325 billion in treasuries, it means in the US market there is no value. The fee is okay with Vanguard, so if you have something like this, you have a pension fund in Canada, poor you, what can I say? But okay, we can go to the emerging markets value factor ETF. The fee is already a little bit more higher there. And if we look at Jeremy Grantham's asset forecast, we see that, as I said, the US has no value. The expected long-term returns, their real returns over the next 7 years are negative, so you will likely lose 40% on real terms, which is crazy. Bonds are a little bit positive, at least you are above water, and emerging value is where the value is. And if we compare the emerging value with the P ratios of the other funds, much better, P ratio of 10, dividend yield is 3 times the S&P 500, price to book value is price to book value of normality. So this would be value. And then if you look at the holdings, they're global, diversified, Alibaba, 200 billion market cap, 50 billion in cash. But of course, China is terrible. You should not invest in that. So that's again another side of the story currently in the market. And they are doing value, they are investing, and we'll see how it ends. But again, you are buying the ecosystem, the AI, for 150 billion, which is much cheaper than anything comparable in the US market. But then again, emerging value is better, but then there is also emerging value, and you have to then invest into the story, into emerging markets. You don't know what will happen there and things like that. So that's a reason why it is much cheaper, and the value investment ETF there is again much cheaper than the S&P 500. But emerging markets are bought at dividend yields of between 8 and 12% and free cash flows of 20%, not 3% dividend yield. So if the US crashes, emerging markets will go from 3 to 6 like this. And this all looks good, but if I look at one company that I cover, so the dividend yield there is 5.24%. This is the normal yield in Asia, not 3%. So again, an ETF is buying the most expensive. You might have understood it. I don't like ETFs. I prefer looking, I prefer knowing. I don't like any modeling because I think that's the wrong mindset, because then you start following things from a relative perspective and it simply works until it doesn't. And that's something I don't like personally. So I try to explain things here, but I really don't like ETFs, so it's very hard for me to focus on this. Yes, emerging markets are a better ETF. Berkshire is perhaps the best US ETF now. So if you need to focus on the US, just buy Berkshire. That's it. Like many are doing, and unfortunately the stock is going higher and higher. But it is much better than anything else out there, given the risks from a value investment perspective. Then you can think about emerging markets value, but then again, with an ETF you're buying the good and you're buying the bad. That's again always the problem there. So yes, it is cheaper, it is value, but there is then the dispersed risk of not buying individual stocks. So it is up to you how you feel about building wealth over time. I think that if you buy the emerging value ETF, you will build wealth over time. We have discussed Berkshire many times. You will build wealth over time. If you buy the S&P 500, you just must be ready that when the bubble expires, it reverts to the mean, or value ETFs that we discussed from the US, when they revert to the mean, you just need to keep on buying at the lows as you do now, and over time you will build wealth. So that's the story. I do something completely different personally, so nothing wrong. I hope I explained that it is not value from an absolute perspective, it is from a relative perspective. That's the value I think I can give you, and then you have to see how that fits in your portfolio. If you have an automatic buy every month, a little bit here where it's cheaper, a little bit more, a little bit less when it's more expensive, over time you can build wealth over ETFs. So no problem there. It's just my personal, but that's something completely different. I think there are value investing ETF channels here on YouTube, so you might follow those. If you are focused on building value and having the right mindset, then this is the channel to be, of course. Hope you enjoyed the video. I tried to do my best, and I'll see you in the next one.